Let me tell you about the best days of my investing career. They were not the days when the market was hitting all-time highs. They were not the days when everyone was celebrating and popping champagne. The best days of my 70-plus years in the market were the days when blood was running in the streets, when panic was everywhere, when people were selling everything they owned at any price just to get out. Those were the days when fortunes were made. And I am going to tell you exactly which 5 stocks I would buy the day after a 40% market crash. Not someday, not maybe. These are the 5 companies I would put my money into immediately when everyone else is running for the exits. Now, before I reveal these 5 stocks, let me take you back to a moment that shaped everything I understand about crisis investing. It was October of 2008. The financial system was collapsing. Lehman Brothers had just filed for bankruptcy. AIG was being bailed out. People genuinely believed the entire banking system might fail. The S&P 500 was in free fall. It would eventually drop 57% from its peak, 57% more than half of the stock market value wiped out. And do you know what I was doing? I was buying, not just buying, I was writing op-eds in the New York Times telling everyone else to buy too. The headline was simple: Buy American. People thought I had lost my mind. They thought the Oracle of Omaha had finally gone senile. How could anyone buy stocks when the world was ending? But here's what I understood that most people did not. Great companies do not become worthless overnight. Their factories do not disappear. Their brands do not evaporate. Their customers do not vanish. A 40 or 50% drop in stock price does not mean the business is worth 40 or 50% less. It means that fear has taken over from reason. And when fear takes over, that is when the real opportunities appear. During that crisis, I invested $5 billion in Goldman Sachs. I put $3 billion into General Electric. I made deals that seemed crazy at the time, but turned out to be some of the most profitable investments of my career. Why? Because I was buying wonderful businesses at prices that did not reflect their true value. I was buying when everyone else was selling. Now, let me be very clear about something. I am not rooting for a crash. I do not want to see people lose their savings or their homes or their retirement funds. But crashes happen. They are an inevitable part of capitalism. And if you are prepared, if you know what to buy and have the courage to act, a crash can be the greatest wealth-building opportunity of your lifetime. So here are the 5 stocks I would buy the day after a 40% market crash. And more importantly, I am going to explain why each one meets my criteria for a crisis purchase, because the specific names matter less than understanding the principles behind the choices. The first stock I would buy is Apple. Now, I know what some of you are thinking. Warren, Apple is already one of Berkshire's largest positions. You already own a massive stake in this company. Why would Apple be your first purchase in a crash? Let me explain why Apple becomes even more attractive after a 40% decline. Apple is not just a technology company. Apple is a consumer behavior company that happens to make technology products. And consumer behavior, once established, does not change during recessions. It does not change during crashes. It does not change during anything short of complete societal collapse. Think about what Apple has built. Over 2 billion active devices in people's hands around the world. 2 billion. These are not just phones and computers. These are extensions of people's lives. Their photos are there. Their messages are there. Their music, their apps, their entire digital existence lives within the Apple ecosystem. Do you think a stock market crash makes people throw away their iPhones? Do you think a recession makes people abandon their digital lives? What happens is the opposite during economic stress. People hold on to their existing Apple products longer. They might delay upgrading for a year or two, but they do not leave the ecosystem. And eventually, they upgrade. They always upgrade, because once you are in the Apple world, leaving is almost unthinkable. But here is what really excites me about buying Apple after a crash. The services business Apple now generates over $100 billion per year in services revenue. This is not hardware that depends on people buying new phones. This is recurring revenue from iCloud storage, Apple Music, the App Store, Apple Pay, Apple Television Plus, Apple Fitness, Apple Arcade. Every month, over 1 billion people pay Apple for something. That revenue is sticky. That revenue is predictable. That revenue does not disappear because the stock market dropped. If Apple stock fell 40%, you would be buying this incredible services business at a massive discount. You would be buying the hardware business, which still generates enormous profits, at a massive discount. You would be buying one of the most valuable brands in human history at a massive discount. And you would be buying a management team that has proven time and time again that they know how to allocate capital intelligently. During a crash, I would not hesitate. Apple would be my first call. The second stock I would buy is Coca-Cola. And I can already hear the objections, Warren. Coca-Cola is a boring company. Coca-Cola does not grow very fast. Coca-Cola is not going to make anyone rich overnight. Why would you buy Coca-Cola in a crash when you could buy something more exciting? Let me tell you why Coca-Cola is exactly what I want when the world is falling apart. Coca-Cola sells happiness. Coca-Cola sells a moment of pleasure that costs less than $2. And when times are hard, when people are stressed, when the news is terrible, that $2 moment of happiness becomes more valuable, not less. I bought my first shares of Coca-Cola in 1988. Do you know what has happened since then? The stock has returned over 2,000%, not including dividends, 2,000%. And I have not sold a single share. Why? Because Coca-Cola is not just a stock. Coca-Cola is a compounding machine that pays me increasing dividends year after year after year. During a crash, something magical happens with dividend stocks like Coca-Cola. The dividend yield goes up. If Coca-Cola normally yields 3% and the stock drops 40%, suddenly you are looking at a 5% yield from one of the safest companies on earth. You are being paid 5% per year to own a company that has been increasing its dividend for over 60 consecutive years. 60 years of dividend increases through recessions, through wars, through financial crises, through everything. That dividend is not going anywhere. The company generates so much cash that they could not stop paying the dividend even if they wanted to. And every year, they raise it. So the shares you buy during the crash pay you more and more as time goes on. This is not speculation. This is not hoping the stock price goes up. This is owning a piece of a money printing machine and collecting your share of the profits. There is another reason I love Coca-Cola during a crisis. The brand is global, truly global. More than 2 billion servings of Coca-Cola products are consumed every single day in virtually every country on earth. This diversification is incredibly valuable when you do not know which regions will recover fastest from a crash. Maybe the US takes longer to recover. Maybe Europe bounces back quickly. Maybe emerging markets lead the way. It does not matter. Coca-Cola wins regardless because Coca-Cola is everywhere. When panic hits, I want to own businesses I understand completely. Businesses with products people need and want regardless of economic conditions. Businesses that generate mountains of cash and return that cash to shareholders. Coca-Cola checks every single box. The third stock I would buy is American Express. Now this might surprise some people because American Express is a financial company, and financial companies often get hurt badly during crashes. But American Express is different from other financial companies in ways that most people do not appreciate. American Express does not serve everyone. American Express serves the affluent. Their average cardholder has an income of over $100,000 per year. Their Platinum and Centurion cardholders are even wealthier. And here is the key insight. Wealthy people do not stop spending during recessions. They might spend a little less. They might trade down from first class to business class, but they do not stop traveling. They do not stop dining out. They do not stop living their lives. I have owned American Express since the 1990s. I watched the company during the 2008 financial crisis. I watched it during the pandemic crash in 2020. And every single time, the American Express customer proved more resilient than people expected. The spending came back faster. The credit losses were lower. The business recovered more quickly than competitors focused on lower income customers. But there is something else about American Express that I find extraordinary. The closed-loop network, unlike Visa and MasterCard, which just process payments, American Express owns the entire relationship. They issue the cards, they process the transactions, they own the merchant relationships. This gives them data and pricing power that competitors cannot match. When you buy American Express after a 40% crash, you are buying this closed-loop network at a discount. You are buying access to the spending habits of millions of affluent consumers at a discount. You are buying a brand that commands premium pricing and customer loyalty at a discount. These advantages do not disappear because the stock price dropped. They just become cheaper to own. I should also mention something about American Express that relates to crisis investing, specifically during crashes. There is always a flight to quality. People become more risk-averse, businesses become more careful about expenses, and in that environment, premium brands often do better than discount brands. American Express is the ultimate premium brand in payments. When a business wants to signal that it is serious, that it is established, that it is trustworthy, accepting American Express sends that signal. This intangible brand value is worth billions, and you cannot replicate it no matter how much money you spend. The fourth stock I would buy is Bank of America. Now, I need to explain my thinking here carefully because banks can be dangerous during financial crises. We saw what happened in 2008. Banks that seemed solid turned out to have hidden risks. Banks that seemed well capitalized turned out to need bailouts. So why would I buy a bank the day after a 40% crash? The answer is that Bank of America in particular has transformed itself since 2008. Under Brian Moynihan's leadership, this bank has become one of the best managed financial institutions in the world. They have simplified the business. They have strengthened the balance sheet. They have focused on serving customers rather than making risky bets. And they have built a deposit franchise that is extraordinarily valuable. Bank of America has over $2 trillion in deposits. $2 trillion, these deposits cost almost nothing. Customers keep money in their checking accounts, earning minimal interest. And Bank of America takes those deposits and lends them out at higher rates or buys securities that yield more. The spread between what they pay for deposits and what they earn on assets is pure profit. And that spread widens during certain interest rate environments. Here's what most people miss about buying banks during a crash. Yes, credit losses increase. Yes. Some loans go bad, but banks are in the business of managing risk. They have loan loss reserves. They have capital cushions. They have centuries of experience managing through downturns. A well-managed bank like Bank of America does not just survive a crisis. It comes out stronger because weaker competitors fail and market share consolidates. During the pandemic crash in March 2020, Bank of America stock fell almost 50% in just a few weeks. It recovered completely within about 18 months. If you had bought during that panic, you would have nearly doubled your money while collecting dividends along the way. I expect a similar pattern in any future crash. Bank of America will decline sharply because all financial stocks decline sharply during panics. But the underlying business is solid, the recovery will come, and patient investors will be rewarded. I should also mention that Bank of America is a play on the American consumer and the American economy. They have relationships with tens of millions of households. They see the data on spending, on borrowing, on saving, and that data tells them exactly how the economy is doing in real time. This information advantage is worth something. When you own Bank of America, you are not just owning a bank, you are owning a window into the American economy. The fifth stock I would buy is Chevron. Now, energy stocks are controversial. I know that many younger investors do not want to own oil and gas companies for environmental reasons. I respect that perspective. But let me explain why Chevron makes sense as a crisis purchase from a pure investment standpoint. The world still runs on oil and gas. That is just a fact. Transportation runs on oil. Manufacturing runs on oil. Agriculture runs on oil. Heating runs on natural gas. Electricity generation uses natural gas, no matter what your views on climate change. The reality is that we cannot flip a switch and stop using hydrocarbons tomorrow. The transition will take decades, and During those decades, companies like Chevron will continue generating enormous amounts of cash. They will pay substantial dividends. They will buy back shares. They will reward patient shareholders. And here is the key: during a market crash, energy stocks often get hit particularly hard because people assume a crash means a recession, which means lower oil demand, which means lower oil prices. But that analysis misses something important. Oil prices are set by supply and demand globally, not just in the United States. Even if American demand drops during a recession, demand from China, from India, from Southeast Asia, from Africa continues growing. And supply is constrained because oil companies have not been investing enough in new production for years. There simply is not enough new oil coming online to meet growing global demand. So when you buy Chevron after a 40% crash, you are buying a company that will continue generating cash regardless of short-term price movements. You are buying a company that has maintained and increased its dividend for over 30 years. You are buying a company with a pristine balance sheet that can weather any downturn. And you are buying at a price that assumes the worst-case scenario, which rarely actually happens. I should also mention that Chevron has been intelligent about the energy transition. They are investing in carbon capture. They are investing in hydrogen. They are investing in renewable fuels. They are positioning for a future that looks different from today, while still generating massive profits from traditional energy. That balance is exactly what I want in a long-term investment. Now let me step back and explain the common principles behind these 5 stocks, because understanding the principles is more valuable than knowing the specific names. First, every one of these companies has what I call a moat, a sustainable competitive advantage that protects them from competition. Apple has its ecosystem, Coca-Cola has its brand, American Express has its network and affluent customer base, Bank of America has its deposit franchise, Chevron has its reserves and infrastructure. These moats existed before any crash, and they will exist after. The crash does not destroy the moat. It just lets you buy the moat at a discount second. Every one of these companies generates significant free cash flow. They do not need to raise capital during a crisis. They do not need to dilute shareholders by issuing new stock. They do not need to borrow money at high interest rates to survive. They generate more cash than they need, and they return that cash to shareholders through dividends and buybacks. During a crisis, this cash generation is priceless. It means the company controls its own destiny regardless of what the market or the economy does. Third, every one of these companies is run by competent management that thinks long-term. I am not buying stocks. I am buying pieces of businesses. And when you own a business, you are essentially partnering with whoever is running it. I want partners I trust, partners who will make smart decisions during a crisis, partners who will use the crisis to strengthen the business rather than just survive it. Fourth, every one of these companies is something I understand. I know how Apple makes money. I know how Coca-Cola makes money. I know how American Express makes money. I know how Bank of America makes money. I know how Chevron makes money. This understanding gives me conviction. And conviction is what you need when the world is panicking and everyone is telling you to sell. Let me tell you something about conviction. During a crash, you will be tested. The financial media will be full of doom and gloom. Experts will be predicting the end of capitalism. Your friends and family will be telling you to sell everything. Your own emotions will be screaming at you to protect yourself by getting out. If you do not have conviction in what you own, you will fold, you will sell at the worst possible time, you will lock in your losses and miss the recovery. I have seen it happen countless times over 70 years. The difference between investors who build wealth and investors who destroy wealth is conviction. And conviction comes from understanding, fifth, every one of these companies will be around in 10 years, 20 years, probably 50 years. I am not trying to time the bottom of a crash. I am not trying to buy today and sell tomorrow for a quick profit. I am buying businesses I want to own for the rest of my life. Businesses that will compound my wealth year after year, decade after decade. When you think about investing that way, a crash becomes a gift. You are being offered the chance to buy wonderful businesses at prices that might not come around again for years. The same companies that were excellent businesses the day before the crash are still excellent businesses the day after. The only thing that changed is the price. And if you are a buyer, not a seller, the lower price is exactly what you want. Now, let me address something important. I said I would buy these 5 stocks the day after a 40% crash. But how much would I buy? How would I allocate the money? The answer might surprise you. I would not try to be too clever. I would not try to overweight the stock I thought would bounce back fastest. I would simply buy roughly equal amounts of all 5. Why? Because I do not know which one will recover first. Nobody does. The economy might recover in ways that favor one sector over another. Interest rates might move in ways that benefit certain businesses more than others. By buying all 5 in roughly equal amounts, I am hedging my uncertainty while still taking advantage of the opportunity. All 5 are wonderful businesses trading at crash prices. All 5 will recover. I do not need to guess which one recovers first or fastest. I just need to be patient and let the compounding happen. Let me also talk about what I would not buy during a crash, because avoiding mistakes is just as important as finding opportunities. I would not buy speculative stocks that were overvalued before the crash when the market drops 40%. Some stocks that were trading at absurd valuations finally dropped to merely expensive. That is not a bargain. That is still a trap. A company trading at 100 times earnings that drops to 60 times earnings is not cheap. It is still expensive. Do not confuse a lower price with a low price. I would not buy companies with too much debt. During normal times, debt amplifies returns. During a crisis, debt kills. Companies that look fine with 4 or 5 times debt to earnings suddenly cannot service their debt when earnings fall. They have to raise capital at the worst possible time, diluting shareholders. Some of them go bankrupt. Avoid them entirely. Only buy companies with conservative balance sheets that can survive anything. I would not buy companies whose business models might be permanently impaired. Some crashes expose vulnerabilities that do not go away when the crash ends. Think about department stores during the pandemic. The crash did not just temporarily hurt them. It accelerated permanent changes in consumer behavior that were already happening. Be careful about companies facing secular decline. A lower price does not make a dying business a good investment. I would not try to be a hero by catching falling knives in the most beaten down sectors. Yes, there might be incredible bargains hiding in the rubble, but there are also a lot of zeros hiding in the rubble. Unless you have deep expertise in a particular industry, stick with the quality names that you understand. You do not need to be clever. You just need to be patient. Let me tell you about the psychology of buying during a crash, because the biggest obstacle is not finding good stocks. The biggest obstacle is overcoming your own fear. When the market is down 40%, everything feels hopeless. The news is terrible. The predictions are dire. Every chart looks like it is going straight down. Your portfolio is showing losses that make your stomach turn, and your brain, which evolved to protect you from predators on the savannah, is screaming that you are in danger and need to flee. This is exactly when you need to buy. Not because it feels good, not because you are confident, but because you understand that prices have disconnected from values, and eventually they will reconnect. Every crash in history has been followed by a recovery, every single one. And the people who bought during the panic, who had the courage to act when everyone else was frozen with fear, those people built fortunes. I have a trick I use to overcome fear during crashes. I ignore the stock prices entirely. Instead, I think about the businesses. Is Apple still selling iPhones? Is Coca-Cola still selling beverages? Is American Express still processing payments? Is Bank of America still making loans? Is Chevron still pumping oil? If the businesses are still operating, still serving customers, still generating revenue, then the crash is temporary. The stock prices will eventually reflect the business values, and my job is simply to buy good businesses at good prices and wait. There's another psychological aspect I want to address. Many people freeze during crashes because they are trying to call the bottom. And they think, bye today, what if it goes down another 20%? And that fear of buying too early prevents them from buying at all. Here's my advice. Fear of success. Forget about calling the bottom. Nobody can do it consistently. Not me, not anyone. Instead, think about whether you are buying at a good price relative to business value. If you are buying wonderful businesses at 40% off, does it really matter if they go to 50% off briefly before recovering? In 10 years, the difference between buying at the exact bottom and buying 20% above the bottom will be trivial compared to the gains you will have made. The enemy of good investing is perfection. People wait for the perfect moment that never comes. Meanwhile, the opportunity passes them by. Do not let perfect be the enemy of good. When you see quality businesses at crash prices, buy them, accumulate gradually if it makes you feel better. But do not sit paralyzed waiting for certainty that will never arrive. Let me close with this thought. Every generation faces moments of crisis that feel like the end of the world. I have lived through World War II, the Korean War, the Cuban Missile Crisis, Vietnam Watergate, the oil embargo of the 1970s, the crash of 1987, the dot-com bust, the September 11th attacks, the financial crisis of 2008, the pandemic of 2020. Every single time, the pessimists predicted doom every single time. The economy recovered every single time. The stock market reached new highs. I am not predicting a crash. I do not know when the next one will come. It might be next month, it might be next year, it might be 5 years from now. But I know with absolute certainty that there will be another crash eventually. And when it comes, I will be ready. I will have my shopping list: Apple, Coca-Cola, American Express, Bank of America, Chevron. 5 wonderful businesses that I understand deeply, that have durable competitive advantages, that generate mountains of cash, that are run by competent managers, that will survive anything short of nuclear war. When panic sends their prices down 40% or more, I will be buying while everyone else is selling. And 10 years later, when those positions have doubled or tripled or more, when the dividends have compounded, when the businesses have grown, I will look back on the crash not as a disaster, but as the opportunity of a lifetime. The opportunity that only comes to those who are prepared, who understand what they own, who have the courage to act when fear is everywhere. That is my approach to crisis investing. That is how I have built wealth over 7 decades. And that is exactly what I recommend for anyone who wants to be wealthy over the long term. Crashes are not something to fear. They are something to prepare for, because on the other side of every crash is incredible opportunity for those brave enough to seize it. Be brave, be prepared, and when the day comes, buy the businesses you want to own for the rest of your life at prices you will never see again. That is how fortunes are made, not in the good times when everyone is confident and prices are high, but in the dark times when fear rules and bargains are everywhere. Let me share one more story that illustrates exactly what I am talking about in March of 2020. The world was shutting down because of the pandemic. The stock market crashed faster than at any point in history. In just 23 trading days, the market fell over 30%. Airlines were grounded, restaurants were closed, people were terrified that civilization itself might be collapsing. I watched my portfolio at Berkshire lose over $80 billion in value in a matter of weeks. 80 billion. Most people would have panicked. Most people did panic. They sold everything, moved to cash, and vowed never to invest in stocks again. But here is what I knew that they did not. The businesses I owned were still operating. Apple was still selling phones. Coca-Cola was still shipping beverages. American Express was still processing transactions. Bank of America was still holding deposits. These businesses faced challenges, certainly, but they were not going to disappear. They had the balance sheets to survive any disruption, and when the crisis passed, they would emerge stronger than before. What happened next is exactly what I expected. The market bottomed in late March of 2020 and then began one of the fastest recoveries in history. By August, the S&P 500 had fully recovered all its losses. By the end of the year, it was at new all-time highs. Investors who sold during the panic locked in massive losses. Investors who bought during the panic made fortunes in a matter of months. The same pattern has played out after every crash in history. The 1987 crash, the dot-com crash, the 2008 financial crisis. Every single time selling during the panic was the wrong decision. Every single time buying during the panic was the right decision. And I expect the same pattern to repeat the next time the market drops 40%. Now, some people will say, Warren, this time is different. The problems are worse than before. The economy is more fragile. The debt levels are higher. The political situation is more unstable. And I have heard that argument after every single crash for 70 years. This time is different. It is always different in the details, but it is never different in the outcome. The economy recovers. The market recovers. Patient investors are rewarded. The American economy is an extraordinary machine. It has survived civil war, world wars, depressions, assassinations, terrorist attacks, pandemics, and everything else history has thrown at it. After every crisis, it has come back stronger. After every panic, it has reached new heights. I am betting that pattern continues, and I think that is a very good bet. Let me give you one final piece of advice about how to actually execute on this strategy. Do not wait until the crash happens to decide what you will buy. Make your list now, study the businesses now, build your conviction now, because when the crash comes, you will not have time to think clearly. Fear will cloud your judgment. Urgency will make you impulsive. The only way to act rationally in a crisis is to have done all your thinking ahead of time. I have my list ready. I know exactly which businesses I want to own more of at lower prices. I know exactly why each one is a great business. I know exactly what price would make each one an irresistible bargain. When the crash comes, I will not need to think. I will just execute. You should do the same. Maybe your list is different from mine. Maybe you understand different businesses better than I do. That is fine. The important thing is to have a list of quality businesses you would love to own at lower prices. Study them now, understand their competitive advantages now. Build your conviction now. Then when the crash comes, you will be ready. The dark times are coming eventually. They always do. The question is whether you will be ready to act or whether you will be frozen like everyone else. I know which one I will be. I hope you will join me. And remember, the goal is not to get rich quick. The goal is to get rich for certain, patient. Disciplined investing in quality businesses bought at reasonable prices has created more millionaires than any other strategy in history. Crashes just give you the chance to accelerate that process by buying at unreasonable prices. Prices that the market in its panic is practically giving away. That opportunity is coming. It might be next week, it might be next year, it might be 5 years from now, but it is coming. And when it arrives, the prepared investor will act while the unprepared investor freezes. Be the prepared investor, make your list, build your conviction, save your ammunition, and when the moment comes, pull the trigger without hesitation. That is how I have invested for over 7 decades. That is how I will continue investing for as long as I am able. And that is what I recommend for anyone serious about building wealth over the long term. Crashes are not disasters. They are opportunities. And the biggest fortunes are made by those who recognize the opportunity when everyone else sees only disaster.